In this chapter, we look at pricing decisions. Now, there are many strategies that can be adopted when pricing a product or a service, and given today's competitive industries with short-lived products and the prevalence of service industries, pricing decisions can be really vital. Now, we're going to look at a mixture of economic theory in terms of demand and elasticity and optimal pricing, and also some common sense practical pricing strategies. Questions on pricing are likely to include calculations, discussions, and very much the practical application of pricing strategies. You're going to apply this theory to the particular circumstances of the business in an exam scenario.
Section 1 and the first part of Section 2 deal with the factors that influence price and demand. So have a quick look at Section 1.1. Section 2, the first bit here is concerned with price elasticity of demand. Price elasticity of demand is basically measuring how responsive our demand is to any change in price that we make. Now, understanding this is important because it allows you to understand whether you're able to set a higher selling price for your goods or whether you do that, demand will fall and actually you'll bring in less overall revenue. Now, price elasticity of demand is calculated as a percentage change in quantity over your percentage change in price, and that's not a formula that you're going to be given in the exam. You do need to learn that one. Now, when you use that formula, if you get a result which is more than 1, you have elastic demand. Now, what that means is a small change in price will have a big change in the quantity demanded. So you put your price up a little bit, your sales volumes will fall significantly. If you get a result of less than 1, you've got inelastic demand and you can put up your prices without seeing a large impact in demand. Lecture example 1 is an example which is asking you to calculate your price elasticity of demand, and we're looking here at a change in the price increase of $1. What we know is that if the ticket prices are $12, we get attendance of 16,000. When we increase the prices by that dollar, attendance falls by 2,500 units. So let's remind ourselves of our price elasticity of demand formula. What we are looking at is the percentage change in quantity demanded over the percentage change in price. So have a go at calculating the price elasticity of demand. You may wish to pause this presentation while you do that. So hopefully your answer to example 1 looks something like this. We end up with a price elasticity of demand of 1.9, and because that is greater than 1, that indicates that we have elastic demand. Now, section 2.7 looks at our demand function. Basically, this is looking at the relationship between price and demand and using that to understand what level of price we should set to generate a given level of demand. Now, the graph we've got here shows a downward sloping line, and that is normally the case where we have imperfect competition. In order to sell more units, we would have to drop the price in order to do that. Now, depending on the gradient of this line, you'll be able to have a feel for how elastic your demand is. A steep demand curve shows inelastic demand. A relatively or flatter curve shows elastic demand. Now, the formula that we can use to understand this relationship is P is equal to A minus BQ, and you'll be given that in the exam. P is your selling price. Okay. Q is the quantity that's demanded at that given selling price. Value for A is your theoretical maximum price. If you set your price any higher than A, you won't get any demand at all. And B measures the change in price over your change in quantity. So in order to use your demand function, the question will give you detail to be able to work out B, and it will give you P and Q. So the first thing you do once you've got the value for B is use this formula to find out the value for A. Having got that, you know what your demand function is, so you use those values for A and B in solving the specific requirements of the question. So if it's to find the price you should charge to sell a number of units, you'll put that number of units into Q along with your values for A and B, and it would give you your resulting price. Similarly, if you want to know how many units I can sell if I set my price at X, put that price along with A and B into this formula, and then it will tell you your quantity. Now in example 2, we're extending our football club example from 1 a little bit more. The initial data is exactly the same, $12 a ticket, and we get attendance of 16,000. And you can see when we change the price by $1, we're still looking at a change in 2,500. What we need to do now is work out what the ticket price should be if we want to sell 25,000 tickets. Now we're assuming this is purely price dependent, so what we need to do here is use our demand function. Now a demand function is P is equal to A minus BQ. Now whenever you're faced with your demand function, I would solve B first, and then you can drop everything else into the formula along with B. So for B, what we're looking at here is our change in price over our change in quantity. So here we were changing our ticket price by $1, and that led to a change in our attendance of 2,500 people. So the value for B, 0.0004. You'll often get values like this for B, so do be careful, make sure you bring in the right number of zeros. So let's drop that into our demand function along with the other bits that we can from the question. In terms of P, well, we know that our current ticket price is $12. A is going to be the item that we need to solve. B, 0.0004. And our quantity, well, our quantity, when our price is $12, we get 16,000 in attendance. So what we now need to do is use this information to work out the value of A, our theoretical maximum price. So A is therefore 1840. Now we're going to use this value of A and drop that back into our demand function, put in our desired quantity and find out what that selling price must be. Okay, so what we're going to do now, price is what we want to find out. We know that A is 1840. We know the value of B. And we want to know the price when we have 25,000 in attendance. So what we can therefore work out is that we need to set our price at $8.40, and if we do that, we'll sell 25,000 tickets. Okay. Now in this particular example, we were asked to find the price for a given attendance. We could be given the price and work out how many items we can sell for that. Whichever way the question is worded, you first of all need to solve your demand function. So always find the value for A and then drop that into your demand function with B and then solve either P or Q depending on the requirements in the question.
In this section, we're going to look at optimal pricing, which is another concept in economics. Now, the little chart that you've got here, the picture, you don't need to be able to reproduce that in the exam. It's purely just to help your understanding. So what you can see is if we plot the total cost line and the total revenue line, total revenue goes up and then starts to fall. Total cost goes down and then starts to rise. So there is a particular point, the optimum point, when our profit is maximised. The distance between those two lines is at its maximum. Now, how we find that is that we need to look at the marginal revenue and the marginal cost. Marginal revenue is the increase in total revenue from selling one more unit, and the marginal cost is the increase in total cost from producing one more unit. So they're drawn here as lines on this diagram, and it's the gradient of the total cost line and the gradient of the total revenue line which give us those marginal lines. And once those gradients are equal, that's when we do profit maximisation. And that's what gives us the optimal pricing. Now, the other little bit that we need to know is how to calculate that marginal revenue. So we've got another little equation here. That one is given to you in the exam. So you don't need to learn it, we just need to know how to use it. The other thing to be aware of is that the marginal cost, of course, is usually the variable cost of producing a unit. And that should be given to us in the question. So now we need a step-by-step approach for how to calculate this profit maximising output.
In this example then, we're being asked to determine the price that should be used to maximise profit. And profit is maximised where the marginal revenue is equal to the marginal cost. And we're told here that the marginal cost per unit is equal to $5. So we need to work out the value for the marginal revenue. And in order to do that, we need to follow the four-step approach. So we're going to need to start off by working out the value of the demand function. The demand function, remember then, is P equal to A minus BQ. So we start off by working out the value for B. And we're told here that research has shown that when the prices were changed by $1, so that's the change in price, there will be a change in units of 2,000. So B is equal to 1 divided by 2,000, which is equal to 0.005 units. So that's the gradient then of our line. What we need to do now then is say, well, we know at the moment what the selling price is, and we know what the quantity is because we're given it in the scenario. So at the moment they charge $18 and sell 17,000 units. So we've got out of our demand function a value for P, a value for Q, and a value for B. So we can use this then to work out the value for A, which remember is the theoretical maximum price. It's the price at which the quantity demanded would be equal to 0. 18 is equal to A minus 8.5. So to get A on its own, we need to add 8.5 to both sides. So A is equal to 26.50, and that is the theoretical price at which the quantity demanded would be 0. So the demand function is P is equal to 26.50 minus 0.0005 Q. And we'll come back to that in a moment when we've worked out the profit maximising quantity. So the profit maximising quantity then is going to be where the marginal revenue is equal to the marginal cost. So 5 is equal to 26.50 minus, and the formula, remember, for the marginal revenue is A minus 2BQ. So that'll be 2 times by 0.005, which is 0.001. So we can now rearrange this formula to work out the value for Q. So 0.001 Q is equal to 2650 minus 5. So Q is equal to 2150 divided by 0.001. So the theoretical, the ideal quantity then to maximise profits is 21,500 units. Then we need to substitute that into the demand function. So what's the price going to be when the quantity is 21,500? Remember, we revert back to 0.005 at this point because we're back into the demand function. So the theoretical maximum price is going to be $15.75. And that is the price which, if the demand equation is true, if that relationship between price and quantity holds true, that's the price which will maximise profits.
An alternative way to calculate the profit maximising production plan, instead of using all of that algebra, is if we are given information about the costs and revenues at different combinations of output and selling price. So we're going to use lecture example 4 to show us how to do this. So let's look at the marginal cost first of all. So the output's going up by 10 units at a time. So initially our marginal cost is obviously just going from 0 to 10. So it goes up to a total cost of 10. When we go from output of 10 to 20 units, our total cost there increases by 15. So that's our marginal cost. Again, another 10 units, it goes up by 20. From 45 to 70, it goes up by 25. From 70 to 30, it goes up by 30. And finally, it goes up by 35. Then we do the same sort of idea with the selling price, because what's happening, you can see, is our selling price is going down so that we can sell more. So our total revenue is 50. So obviously we've gone from 0 to nothing. So there's our marginal revenue. When we get to 450, we are got 20 units times by 450 is 90. So again, looking at the marginal situation, that's gone up by 40. 30 times by 4 is 120. So that's gone up by 30. 40 times by 350, 140, gone up by 20. So again, you can see this marginal revenue is declining as we would expect. That's gone up by 10. 250 times by 60 is 150. And that hasn't gone up at all. Now, if we look at the profit figures, what we need to do is to take the total revenue and deduct the total cost. So the profit at 10 units is 40. Total revenue minus total cost at 20 is 90 minus 25, giving us 65, and so on all the way down, taking the total costs away from the total revenues. And what you can see there, without even worrying about the economics of it, is that your maximum profit is at 75, and that's when you make 30 units. Those 30 units will be sold at £4 each, $4 each. So more of a common sense logical sort of approach rather than using all the algebra and the economics. Now we leave the economics behind a little bit and look at practical approaches to pricing strategies. Now there's quite a bit of terminology in here that you need to learn and be able to discuss these various different types of strategies. But remember, always they've got to be applied to the specific circumstances of the company or business in the scenario. So let's start first of all with cost plus pricing, which I'm sure you'll have come across before. And here what we look at is we add a markup to the product's cost. Now the problem here is, what do we mean by cost? Now obviously we could use absorption cost, the traditional way of doing it, the full cost. Now that could also be using ABC as well, which is just a different way of bringing in all the various costs. We could use marginal cost, we could use relevant cost, which is something that we're going to look at in the next chapter. or we could use the standard cost. Again, something we'll come back to later. Now, the advantages of all of that is that it's very easy to understand and easy to apply, regularly used, and there's a reason why it's used, because it's easy. The disadvantage, of course, is that it completely ignores the fact that the price will affect how many people want, and it won't necessarily maximise profit. Of course, we also know when we're doing absorbing overheads, there's all sorts of things that we can do with that, and it is affected by activity levels. The other thing, of course, is that market conditions will affect the price that can be charged. So here we've got a little bit of a link to when we were talking about target costing. What's the market prepared to pay? There's no point in making something which costs more than the price that you could get for it. So now we move into some possibly new terminology for you. First one, market penetration. The idea of this is that you hit the market with low prices when you first launch a product. So for example, Sky TV, when it was first launched, you make it very cheap. Of course, you can always put the prices up later, but the idea is that you're trying to get market share. Now, the big advantage of this is it stops new entrants into the market. And it means that the initial period of the product life cycle, again, think about what we did in an earlier chapter about product life cycle, it shortens it a little bit. And obviously it's useful if you've got economies of scale. By economies of scale, the more you produce, the lower the average cost is. So if you can make as much as possible and sell as much as possible, then your costs will go down. Now, market skimming is the opposite of market penetration. What you do is you charge a high price at the launch of the product, and you spend heavily on advertising, sales promotion to get those sales. Think of something like a new computer games console. That's a classic way at Christmas. You make it very expensive, you make it very attractive, the must-have buy. As you move into the later stages of the life cycle, so again, a little reminder about the life cycle, we're talking about growth, maturity, and ultimately decline, you do progressively lower charges. So what you're trying to do is to grab the profits early in the product's life. So again, we need to think about the type of products. So if it's new, if it's different, and customers are going to be prepared to get hold of that new product. It's also potentially going to have quite a short life cycle, so you might want to get the development costs back quickly. Premium pricing then. This is making something look different, so you're trying to justify a premium price here. Now, this can either be a real difference in quality or reliability, or it can also be as a result of heavy advertising, so brand loyalty, meaning that it's got that cachet, it's something that you want. So for example, Tiffany's, if you buy jewellery from there, you get that very distinctive blue box. And of course you can charge more money. Now, price discrimination. This is where you have got two very separate markets or more than that, but you must not be able to transfer from one market to the other. A very good example of this is train travel. You pay a lot more money to travel at peak time than you do off peak, and you will not be able to travel. Well, you can travel in both, but not simultaneously, so they are separate markets, and it's something that everybody accepts. So to be successful, you've got to not be able to transfer it, but you can charge a different price in each market. Product bundling, again, you'll have come across where you group a whole load of products into a package. So for example, a package of DVDs, the James Bond DVDs will be put into a package, and then you can sell the whole thing lower than each of those separate DVDs would cost. Psychological pricing appeals to what we think when we buy something. So, for example, a product could be priced at $19.99 instead of £20, and you think that's some part of your brain thinks that therefore is acceptable. Another thing that's used sometimes by companies is to take an unsuccessful product off the market and then repackage it, relaunch it at a higher price, and that gives it this image of being a better quality product. Product line pricing then. This is where we have a whole range of products. So what you look at is the profit from the whole range, not the profit on each separate part. So classic for this, for example, would be Sony TVs and various other electrical equipment. So quite hard to work out whether you're getting a good deal on one particular part of the range. Complementary product pricing is a similar sort of idea really, only in this case you've got separate products but they're used together. So you could make one part of it very cheap, but then in order to get a refill, for example, you then have to pay a lot more money. A good example would be razors. The razor itself could be very cheap, but then the razor blades are expensive, and that's where the business makes its profit. Another concept that you're probably quite familiar with, even if you don't know the terminology, is loss leader. So this is, for example, a supermarket gets you into that supermarket because a particular brand of product that you really like is on offer. Very, very low price for a can of baked beans, for example. And that then gets you into the supermarket to get you to then buy other products, which obviously will have higher profit margins. Control pricing, here we're talking about a monopoly. A monopoly is where you've only got one business, one provider in a particular market, and they potentially can charge very high prices because they've got control. Also, the demand for that product is inelastic. So here we're looking at things like water supply, gas, electricity, and because of the monopolistic power, you get regulation in those markets. So Ofwat, Ofgem, etc. They are regulating those markets to make sure that customers get value for money. Otherwise, they charge too high prices. Finally, a volume discount. What we mean by that is bulk buying. So if you buy more of something, then you will get a discount on it. This particularly is important when you're looking at wholesale buyers versus retail. So somebody who's buying in bulk will get a cheaper price. Now, when a business is making a decision as to what price to charge, it's very important they don't just look at financial factors. There are lots of other considerations that need to be looked at. And this is where your common sense should come in, picking out relevant information from a scenario. So this section here just gives you some ideas of things that you could look for, such as, for example, the impact on customers, the impact on other products. Product lifecycle, very important here as well. So it's useful at this point just to remind ourselves about the product lifecycle. We've mentioned it a few times in this chapter, but this lecture example looks at a portable DVD recorder. And it wants you to explain the relevance of the product lifecycle when considering which pricing policies should be adopted. So let's just remind ourselves what the 5 stages of the product lifecycle are. So we've got development, introduction, growth, maturity, and final decline. So let's think about which pricing policies would be appropriate at each stage. So obviously at the development stage, you're not actually selling it. But remember that target cost is relevant here because there's no point in making something which you can never make a profit on. So target cost needs to be considered. So in the introductory phase, what kind of policies could we use? Well, we've already looked at penetration pricing. And that's where we have a very low price to start off with to bring in those customers. And that discourages new suppliers to the market. Or we could take the opposite approach and go for a market skimming, which is where we set a very high price, technological, advanced product that would be particularly relevant to because you want to make it seem attractive, give it a good brand image. That then makes it very profitable to start off with, but of course you're going to attract potential competitors in. In this particular case, because it's technologically advanced, we're probably looking at skimming rather than penetration. Now, that high price is going to act like a signal for your competitors to move in on those profits. So competition is likely to go up. So therefore, the price may well have to come down at that point. And that process will carry on really into the maturity stage as well. The maturity stage, it's really the market that's going to set the price. It's what the customers will actually pay for that particular product. And to make a profit, really the focus is going to have to be on costs. You've got to keep your costs under control at that point so that you can carry on making a profit from a product for which you can no longer charge a premium price. As it goes into decline, you may still have some loyal customers, but you're probably going to have a low price just to sell off all the remaining inventory or stock if you possibly can. The idea is, in a technologically advanced sort of product like this, that once it becomes obsolete, that's it. So really you'd already be looking at a replacement. Now to summarise what we've covered in this chapter, we started off with quite a bit of economics really in terms of the demand and elasticity, and then also more economics looking at the profit maximising output, MR equals MC, optimal pricing. Now in both of these you need to understand what's going on, be able to use the techniques, do the calculations, but also be able to explain what it all means. We then moved on to the more practical common sense aspects. So here we're looking at pricing strategies that a business could use with lots of bits of terminology that you need to be able to discuss. And also, again, suggest suitable pricing strategies for the particular circumstances of a business in an exam scenario. Not forgetting that it's not just all about the numbers, there's lots of other considerations as well, particularly looking at product life cycle.